Welcome to the deep dive. Today we are wrestling with, well, a magnificent high-stakes paradox. It's playing out right now in the world's most cutthroat market, Chinese electric vehicles. We are taking a deep dive into XPeng Inc., ticker XPEV.
And this is a company operating, smack bang in the middle of a market defined by just brutal price wars, massive consolidation happening all around them, and this relentless burning of cash just to keep, market share.
Exactly. And the paradox we are here to unpack is, well, it's stark. Our analysis of the fundamentals, using our educational discounted cash flow model, it suggests that XPeng's stock is currently, get this, overvalued by 180.5%.
Wow.
That is a pretty strong quantitative rejection of the current market price, wouldn't you say?
Absolutely. It's a huge number. However, that mathematical conclusion, it stands in direct conflict with the actions of the person who arguably knows the company best.
Right.
Just 2 months ago, XPeng's founder and CEO, He Xiaopeng, he personally invested $32 million of his own money into the stock.
$32 million.
Yeah, and at a price dramatically lower than where it's trading today.
So what's the reality here? Is XPeng just another, cash-burning commodity automaker, maybe destined to be crushed by the volume giants like BYD?
Okay.
Or is the CEO's conviction justified? Is it because XPeng is secretly building and, maybe more importantly, licensing the core technological brain for the entire future global auto industry?
That question, I think that's the mission of this deep dive, isn't it?
Yeah.
We are using data anchored to the closing share price of $26.72 on November 12, 2025.
Okay.
And our goal really is to figure out if the market's aggressive bullish momentum right now is based purely on narrative hype, the AI story, or if there has been a fundamental strategic shift.
A real shift.
Yeah, a shift from just building, say, low-margin hardware cars to licensing high-margin software, the brains.
Okay, so we'll follow a rigorous 7-chapter analysis path. It's designed to cut through all that noise. We'll start by establishing the core technology moat, then move through management accountability and the financial pivot. And finally, we'll assess the risks, the strategic ownership, and of course, that ultimate valuation paradox we started with. Let's get started. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding.
Okay, so the absolute starting point for this whole thesis is how the company defines itself. XPeng insists it's not just a car company, it's a smart EV company.
Right.
And look, this is more than just, marketing jargon. It really is the foundation of the entire bull case for the stock.
And what does that mean practically, like in terms of how they structure their engineering? Because historically, most automakers just outsource major components, right?
They do, but XPeng operates on a strategy of, extreme vertical integration. It's costly, definitely, but they see it as essential for their long-term vision.
So what are they integrating?
They design and develop their own powertrains, their electric-electronic or E-architecture that's like the nervous system of a modern car, and critically the full-stack advanced driver assistance system, ADA. All of it, entirely in-house.
Okay, full stack. When you say that, it implies they own the whole process, right? From maybe the silicon chip itself right up through the final user interface someone sees in the car.
Exactly.
Why is that vertical control so crucial compared to, say, competitors who might just buy their ADOs from a third party like Mobileye or someone?
Well, because control over the full stack, that's really the only way they believe they can achieve truly high levels of autonomy. We're talking L3 and eventually L4 autonomy.
Right, the higher levels.
They're not just, integrating disparate systems from suppliers. You're building a unified, constantly learning platform. If you rely on external suppliers, you inevitably sacrifice the speed of iteration. And, maybe more importantly, you lose that crucial control over the data loop that trains the AI. That feedback is everything.
Okay, that makes sense. And their target market seems to reflect this tech focus too, right? Tech-savvy, middle-class consumers.
Precisely. They're selling an experience, you could argue, not just basic transportation. They are offering, arguably, the best domestically produced self-driving technology in China.
Aiming for that sort of Tesla-like experience.
Exactly, but crucially, at a significantly lower entry price point. And that's key if you want to win over the massive Chinese consumer base.
Okay, let's break down where the money's coming from. So the Q2 2025 financials, they show vehicle sales are still the main driver, right? A massive RMB, 16.88 billion, about $2.36 billion US.
Yeah, the cars are still paying the bills for now.
But there's this secondary revenue stream, services and other. It's smaller, RMB 1.39 billion. But you're saying this is where the high margin future lies.
That's the bet. That secondary stream right now includes things like maintenance and their supercharging network. Pretty standard stuff.
Okay.
But the market is betting heavily that this is where future software licensing, data services, technology licensing, all that high-margin recurring revenue,
Huh.
that's where it will eventually show up in the accounts. This is the stream that could potentially change the fundamental identity of the company from automaker to tech provider.
We absolutely have to talk about their product strategy because the way they're handling this fierce price war, it seems quite clever. You called it a classic barbell approach.
Yeah, I think it is. You see two distinct but actually quite complementary brands operating.
Okay.
On the high-end side, you have the premium XPeng brand. That's the G9 SUV, the X9 MPV, the P7 sedan. These are the margin-focused vehicles, packed with their latest XNGP technology, and they're designed to compete directly against premium players, both foreign like Tesla and domestic competitors.
And what shields that premium brand, the XPeng brand, from having to get dragged into that really bloody, deep discounting price war that's just dominating the lower end of the market in China?
Well, that's the other end of the barbell. The mass-market Moat brand.
Moat,
Yeah,
acquired from Didi, right?
exactly. The Mona MO3, that's the volume engine, the A-class compact fighter, as they call it. It's designed specifically to compete aggressively on price, starting around, what, 17,000 US?
Wow, that's low.
It is. And by isolating those really aggressive, cost-cutting fights to the M&A brand, they effectively protect the price integrity and the perceived quality of the premium XPeng vehicles. I think it's a masterstroke in brand management and navigating this pricing environment.
Okay, let's circle back to the core technology moat you mentioned. The brain. That's the XNGP system.
XNGP, yes. The navigation-guided pilot. This is where those billions in R&D are going. It's their big bet, their commitment to L4 autonomy.
L4 being conditional automation, where the car handles pretty much everything under certain conditions.
That's right. And their rollout schedule is, frankly, a massive operational feat. They're currently expanding the urban driving capabilities, think navigating complex city streets, to 243 cities in China.
243.
Yeah, and they have plans for global development starting in 2025. The speed is key.
And the speed of that rollout, that must create the network effect we touched on earlier. More cars, more data.
Precisely. That data feedback loop, you could argue, is XPeng's ultimate competitive advantage right now. The sources show something like 85% monthly active user penetration for XNGP in their vehicles.
85%. That's huge engagement.
It's massive. Think about it.
Yeah.
Every mile driven by 85% of their entire user base is feeding proprietary data back into the XNGP AI models, constantly improving the system at a rapid pace. This creates a really powerful, hard-to-replicate data moat that competitors, especially those with smaller fleets or less engaged users, simply struggle to match.
And their ambitions, they seem to go far beyond just cars on four wheels. They're betting on physical AI more broadly. You mentioned the iron humanoid robot in this land aircraft carrier flying car.
Yeah, the flying car slated for mass production in 2026, apparently. Look, it's definitely high-risk, long-duration capital deployment, no question.
Sounds like it.
But it is entirely consistent with this narrative shift the market seems to be pricing in. The logic goes something like this. If we can solve full-stack autonomy for a complex machine like a car, we can potentially port that same core AI platform to a robot or a flying vehicle.
So it's about the underlying AI, not just the vehicle form factor.
Exactly. This is the fundamental difference between just being a car maker and potentially becoming a technology licensor, selling mobility platforms.
Okay, let's put their scale in context. They are definitely in hyper-growth mode right now. You mentioned record deliveries, 42,013 in October 2025.
Yep, a 76% year-over-year increase.
And Q2 2025 deliveries surged 241.6% year over year. I mean, that's explosive momentum, confirmed.
Confirmed, yes, the growth is undeniable. But the context here is really crucial for you, the listener, to understand.
Yeah.
Despite this massive growth, there are specific models like the G9 or the P7. They're not actually yet in the top 7 best-selling battery electric vehicle models in China overall.
Ah, okay. So they're growing fast, but from a smaller base compared to the absolute top sellers.
Exactly. They are a fast-growing, successful share taker, grabbing market share from others. But they are still fighting uphill against the sheer scale and volume of giants like BYD and Tesla in that market. It's still a tough fight.
Okay, let's pivot then to the competitive advantages. Specifically, you highlighted two that seem to absolutely validate this high multiple tech company thesis. First, this surprising, almost cult-like brand strength they seem to have overseas.
Yeah, this data point Honestly, it's a staggering competitive advantage, especially for their global aspirations. XPeng became the first Chinese brand ever to top the prestigious German US scale EV satisfaction study in 2025.
And this isn't some, internal Chinese poll. This is validation from German consumers who are known for being pretty demanding, right?
Extremely demanding. And it gets better. The Net Promoter Score, the NPS, it came in at 81%. Now, for context, most automakers, they'd be thrilled to hit 60%.
81 is very high.
It is. But the source material revealed something even more remarkable about that number. The 81% was composed of 81% promoters, people who absolutely love the product and recommend it, and 0% detractors.
Zero detractors. In a customer satisfaction survey, that sounds almost impossible.
Yeah, it's virtually unheard of. It signifies that those who actually buy an XPeng, particularly in that German market study, are almost universally delighted and incredibly loyal.
So what does that mean for their European expansion plans?
It's gold. Pure gold. It means the brand doesn't arrive carrying the baggage of maybe a cheap Asian import stereotype. It enters new European markets already boasting market-leading customer satisfaction. That drastically lowers their marketing costs and should, in theory, speed up adoption significantly.
Okay, that's a powerful advantage. But you said the ultimate competitive advantage, the one that tells us global industrial powers have validated the tech, is the Volkswagen partnership. This wasn't just a typical supplier deal, was it?
No, absolutely not. It was the ultimate vote of confidence, really. VW invested $700 million for a roughly 5% stake back in 2023.
$700 million.
Yeah, and you simply don't hand over that kind of capital without performing exhaustive, deep due diligence on the underlying technology. They essentially concluded that XPeng's tech stack was superior to what they could develop quickly themselves for the Chinese market.
And this leads to this kind of remarkable reverse colonization concept you mentioned. For decades, Western auto giants like VW dictated technology standards. Now, VW is effectively acting as a customer, paying a relatively young Chinese startup to use its core technology.
That's exactly what's happening. They are using XPeng's China Electronic Architecture, the CEA, for their own locally developed models in China, like the ID, Yunwei X08.
Wow.
And perhaps even more tellingly, VW is specifically named as a launch customer for XPeng's advanced VLA 2.0 AI model and their proprietary Turing AI chip.
So VW is buying XPeng silicon too?
It seems so. This is VW effectively admitting, through their actions and investments, that XPeng is years ahead in crucial areas like software architecture and maybe even silicon design for the specific needs of smart EVs in China. XPeng is supplying the brain to the former industrial master, at least in that market. This is the key pivot, the evidence supporting the shift from just building cars to becoming a technology licensor.
And the final piece of strategic brilliance we should touch on in this chapter is the Didi deal, the one that secured the MOA brand.
Yes, that was just a capital allocation masterstroke in my view.
Mm.
They knew they needed a mass market volume generator to survive the price war, right?
Okay.
But they couldn't afford to just burn another $1 billion in cash on an acquisition, especially when their R&D demands for X and GP were so high.
So how did they manage it?
They paid for the M&A brand entirely with stock, XPeng stock, and some performance incentives tied to M&A's success.
No cash down.
Pretty much. This preserved that crucial cash war chest for R&D. And at the same time, it acquired a high-volume product line and secured Didi, which is a massive ride-hailing firm in China, as both a strategic shareholder and, crucially, a built-in fleet customer for the Mona MO3.
So Didi will buy Mona cars for its drivers.
That's the strategic alignment. It's just a win-win-win all around. Brilliant deal structure.
Chapter 2, Management Evaluation. Okay, let's move to Chapter 2, Management Evaluation. Leadership, as you said, is led by the founder, He Xiaoping. He's described as this tech visionary who seems to have successfully transitioned into a more customer-oriented operational executive.
Yeah, and I think we have to assess management not just by their successes, but really by how they handle failures.
Yeah.
And the sources point directly to the launch of the G9 back in 2022.
Right, that was widely seen as a bit of a fumble, wasn't it?
It was an acknowledged operational execution failure. They had confusing trim levels, really complex pricing structures. It just didn't land well with customers initially.
But the key is how they reacted, right?
Exactly. They reacted quickly and, importantly, decisively. They didn't try to deny the errors or spin the story. Management openly acknowledged the failure. They made significant organizational changes, and subsequently, they delivered highly successful, much more clearly marketed launches with the G6, the X9, and now the M1A MO3.
So that shows maturity, wouldn't you say? And, maybe most importantly, adaptability in a market that changes so fast.
I think so. Furthermore, the CEO doesn't seem delusional about the environment they're operating in. His internal letter to employees in 2025 explicitly warned them about the fierce price war and the coming industry-wide consolidation.
So realism.
Yeah, this sounds like a management team that's facing reality head-on, budgeting for the war, if you like,
Yeah.
and using that big cash chest strategically, not just hoping things get better.
Now let's discuss transparency and governance, because this seems to tie directly into their global expansion plans and their ability to attract big institutional capital, that MSCI ESG rating.
Right. XPeng achieved the highest possible rating,
Uh,
AAA.
AAA. Now, that's highly unusual, isn't it? Especially for a Chinese firm operating globally.
Very unusual. And it's massively beneficial for the bull case.
Why doesn't AAA ESG score matter so much? Particularly thinking about Europe. It might seem like a side note to some listeners focused purely on the tech or financials.
Oh, it's anything but a side note. It's actually a key barrier remover for them. You have to understand, modern institutional investors, especially the big funds based in Europe or North America, they often have strict mandates, requirements that mean they can only invest in companies with high ESG scores.
Ah, so it's a box-ticking exercise, but a crucial one.
It's more than just box ticking. A score of AAA signals real ethical strength, good corporate governance practices, and a genuine commitment to environmental standards. It essentially turns XPeng into a safe and easy partner or investment for these huge pools of capital.
Safe and easy? Removes a hurdle.
Exactly. The AAA rating removes a massive potential political and financial hurdle. It makes them a much easier partner for giants like VW, who also have their own ESG obligations to meet. It allows institutional funds to allocate potentially billions to XPeng without running afoul of their own internal mandates or facing uncomfortable questions from their stakeholders. For international expansion, this AAA rating is a non-negotiable competitive advantage that many of their Chinese peers simply lack.
Okay, that's a really important point. Let's turn to their capital allocation strategy now. This really defines their priorities, doesn't it? We talked about the M&A brilliance of the DD deal, paying with stock,
Yeah.
but their entire focus, it seems like 100% of their investment, is centered on widening that technology moat we discussed.
Absolutely. The plan is to invest over CNY $6 billion, which is significant. Some reports suggest potentially up to $7 billion US annually in R&D in 2025 alone.
$7 billion?
Yeah, with $4.2 billion specifically earmarked just for AI development, XNGP, the chips, the whole stack. This level of spending, especially for a company of their current size and profitability, it signals an unwavering commitment to achieving technological dominance, not trying to engineer short-term financial results.
And this commitment, this heavy spending, it directly explains their dividend policy, which is...
$0, zero dividend TTM.
And you'd argue that's the correct strategy right now.
Absolutely. It's the correct, responsible move for a company in this high-growth, heavy investment phase. Management is basically telling the market loud and clear, we believe the highest return we could possibly generate for you, our shareholders, is by reinvesting 100% of our capital right back into XNGP, the Turing chip, our manufacturing scale, and future AI products.
Paying a dividend would signal they've run out of good ideas internally.
Precisely. It would signal a lack of high-return R&D opportunities, which would undermine the entire growth narrative.
But this R&D spending, while you argue it's necessary for the long-term thesis, it creates some really ugly numbers when you look at traditional profitability metrics, doesn't it? Specifically, return on invested capital, ROIC.
It does. That's the tension. The TTM ROIC is deeply negative, negative 6.82%. And return on equity is also negative, negative 13.30%.
Okay, I have to challenge this then. You're telling me management is brilliant, their strategy is sound, but they are systematically losing over 6 cents, almost 7 cents, on every single dollar they invest operationally. How do you defend continuous negative returns like that, even in a growth story? Isn't that just value destruction?
That's a fair challenge. You defend it primarily with the concept of the time lag inherent in these kinds of investments. Think about it. The capital, the billions spent on R&D over the past few years, the factory expansions, the capital has already been spent. It's already reflected in the denominator, the invested capital part of the ROIC calculation. But the return, the net profit generated from those investments, that hasn't materialized yet. It's still in the future. They are deploying capital now with the expectation, the strategic bet, that it will generate significant profits 5, maybe 10 years down the line.
So the argument is that the current negative ROIC is really an investment metric reflecting future bets, not a failure metric reflecting current
That's
operations.
the bull case interpretation, yes.
But what's the proof? What's the tangible evidence today that this massive investment is actually going to yield a positive return eventually and isn't just money going down the drain?
The proof, or maybe the first strong indication, is the financial green shoot we're about to discuss in Chapter 3, the rapidly improving gross margin.
Ah,
The fact that their gross margin has shot up so dramatically recently, that proves the operational strategy itself is starting to work. They're achieving better pricing on their premium models, they're getting better economies of scale in manufacturing, and they're achieving better cost control on components. If that gross margin continues to expand, the path for the negative ROIC to eventually flip positive becomes much clearer and more believable. It's the first sign the engine is catching.
Chapter 3, Financial Health.
All right, now we drill right into the core financial metrics. These are the numbers that either support or completely sink that bullish narrative we've been discussing. We know the market cap is currently around $25.49 billion based on that $26.72 share price from November 12.
And the revenue trend, we mentioned hypergrowth.
Yeah, the reacceleration is explosive.
Yeah.
TTM revenue, so that's trailing 12 months ending Q2 2025, hit $8.391 billion. That represents a massive 65.4% year-over-year increase.
65%.
And Q2 2025 alone, just that single quarter, revenue jumped 125.3% compared to Q2 the previous year. That is absolutely the kind of hypergrowth that these high multiple stocks require to justify their valuations.
But you mentioned the truly critical financial story here is the margin inflection point. You're saying this is the key data point that validates the operational pivot, the recovery from that G9 launch failure back in 2022 to the current execution success we're seeing.
Exactly. That's the narrative the financials are telling right now.
Okay, so let's elaborate on that gross margin shift then. They were at a pretty dismal 1.5% back in 2023, right? Barely covering the cost of the parts in the car.
Yeah, it was worryingly low, basically selling cars almost at cost.
And now they've hit a new historical high of 17.3% in Q2 2025. What does that huge 15-point swing, that improvement, really signify for us?
Well, it confirms, I think, three absolutely critical things for you, the listener, to grasp. First, it confirms they're getting improved supply chain scale and therefore better bargaining power with their suppliers. Costs are coming down. Second, it confirms they are successfully selling a richer, higher margin product mix. Those premium models, the G6, the X9, the P7, are clearly profitable on a gross basis.
Right, the barbell strategy working on the top end.
Precisely. And third, it confirms that those huge fixed costs, the R&D spending we talked about, the manufacturing overhead, are finally being spread across a much wider volume base as deliveries ramp up. This 17.3% gross margin, it's the financial confirmation that they are definitely on a path towards sustainable unit economics. They can make money selling each car, which wasn't clear before.
And we see that improvement cascading down the income statement, right? To the bottom line, the net margin, although it's still negative.
Still negative, yes, but the improvement trajectory is dramatic. They have gone from losing over 50 cents on every single dollar of revenue back in Q3 2023, a net margin of negative 50.39%, which is just staggering.
Bleeding cash.
Absolutely hemorrhaging. To losing only about 7 cents, minus 7.14%, on a TTM basis in Q2 2025. That steep upward trajectory is the financial visualization of their path towards eventual profitability. And the company highlighted that the Q2 2025 net loss was actually their lowest in 5 years.
Lowest loss in 5 years. Okay.
So this confirms that the economies of scale they're achieving are translating directly into massive loss reduction, even while they continue to invest heavily.
Okay, this all sounds fantastic. Huge growth, margins inflecting dramatically upwards, but we have to be realists here. They are still burning cash, aren't they?
Free cash flow, FCF, remains negative, about negative $0.566 billion in 2024.
That's right. The cash burn is real.
So if you're burning cash, your stability, your ability to survive, depends entirely on the strength of your balance sheet, right? How much fuel you have in the tank.
Exactly. And this is where their, let's call it, strategic weapon comes into play. Despite that ongoing cash burn from operations and investment, their balance sheet is actually remarkably conservative and extremely healthy.
Well, they have a low debt-to-equity ratio of 0.56, which is quite good for a company in this capital-intensive phase. Their current ratio is 1.13, suggesting they have sufficient short-term liquidity to cover immediate obligations.
Okay, sounds stable.
But the ultimate defense mechanism, the financial fortress that allows them to withstand the price war and fund their ambitions, is the $6.64 billion they hold in cash, cash equivalents, and short-term investments, as of the latest reporting.
6.64 billion. That is a massive cash pile. That's the management's insurance policy then. The fund to survive the price war.
It's more than just insurance. It's the ultimate signal of their strategic intent. They're explicitly using their massive liquidity as a competitive tool. They've basically said, we have enough capital socked away to fund our ambitious R&D roadmap for years and absorb the financial damage caused by the deep discounting across the entire Chinese market.
Letting them potentially outlast weaker competitors.
That's the strategy. Outlast weaker competitors who might be struggling just to meet payroll or fund necessary R&D. It's financial warfare, and they came prepared with a massive war chest.
Okay, now let's revisit the absolute center of this episode's tension, the valuation analysis. We know traditional metrics kind of fail us here, right? PE ratio is NA because they're still losing money on a net basis.
Correct. No earnings, no PE.
And the forward PE, based on analyst estimates of future earnings, is an eye-watering 148.25x. That's a number that's only really achievable if you assume near-flawless, hyper-exponential future growth for years to come.
Yeah, price is in perfection, essentially. Price to sales PS ratio, currently at 3.04x, is definitely high for a typical hardware or car manufacturer. But, context matters. It's far, far below the insane bubble high of 69.4x they hit back in the 2020 EV frenzy. So high, but not completely unprecedented territory for this specific stock.
Okay. But the DCF model, the discounted cash flow model, which is really the cornerstone of conservative fundamental investing, that's the tool that presents the biggest challenge to the current price, isn't it?
It is. It throws up that major red flag.
Why does the DCF model, which is specifically designed to calculate intrinsic value based on future cash generation, why does it struggle so dramatically with high-growth, negative free cash flow companies like XPeng? And why did our educational model yield that startling 180.5% overvalued figure?
Okay, so the core issue is how a DCF works. It calculates today's intrinsic value based on the sum of all future free cash flows the company is expected to generate, all discounted back to their present value using a discount rate.
Right. Money tomorrow is worth less than money today.
Exactly. Now, when a company is free cash flow negative currently, like XPeng is, the model becomes overwhelmingly reliant on the terminal value. That's the lump sum value, representing all the cash flow assumed to be generated after the explicit forecast period, which is usually, say, 10 years out.
So the price today isn't based on the next few years of expected cash flow, because that's negative. It's almost entirely a bet on what XPeng looks like in 2035 and beyond.
That's pretty much it. When you plug traditional, even quite optimistic but still somewhat conservative inputs into the DCF model, like assuming rapid double-digit growth in vehicle sales for 10 years, the model simply cannot mathematically justify the current $26.72 share price.
Why not?
Because the significant FCF negativity in the near-term years heavily punishes the present value calculation. To actually get a DCF result that justifies the current market price, you would have to plug in incredibly aggressive, almost heroic assumptions.
Like what?
Like assuming massive, nonlinear, extremely high-margin revenue streams kicking in relatively soon from things like AI, software licensing, robotaxis generating huge profits, maybe even flying cars taking off commercially. Things that are not guaranteed and are far outside traditional auto manufacturing economics.
So the DCF calculation, when it spits out 180% overvalued based on more grounded assumptions, it's essentially making a powerful statement, isn't it? It's saying the market is no longer pricing XPeng based on its current or foreseeable car sales business,
Right.
but entirely based on a highly optimistic future where it successfully transforms into a global AI platform company generating software-like margins.
That is the paradox in a nutshell. The current market price is mathematically questionable, maybe even impossible, if you evaluate XPeng strictly using traditional automotive manufacturing assumptions and metrics. The market must be betting on the transformation thesis.
Okay, that sets the stage perfectly. Before we dive into how the market is actually viewing this conflict and, crucially, how the insiders like the CEO are behaving, let's just pause for a quick moment.
Right. If you are enjoying this deep dive, finding this analysis useful, and you want more rigorous, data-driven breakdowns like this on other companies,
Please take just a second right now to like and subscribe to Stock Analytics AI. It really helps us out.
and remember, for just $4.99 a month, you get access to our entire library, over 500 deep dive videos covering all S&P 500 stocks. We're adding the NASDAQ 100 next. Plus, you get access to members-only requested deep dives.
Okay, we will be right back after the short break to tackle market sentiment, the crucial ownership structure, and that all-important risk assessment. Stay with us. Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. Welcome back. We shift our focus now to market psychology, really trying to get a read on how investors are feeling about XPeng. Let's start with the analyst consensus. What are the professionals on Wall Street saying?
Okay, so the overall consensus rating is a moderate buy. About 70% of the tracked analysts covering the stock rate it favorably, either a buy or strong buy.
Moderate buy. Okay, that sounds reasonably positive.
It is. However, there's a nuance here. The average price target among those analysts is currently $25.75.
Wait a minute. If the stock, as we established, is currently trading at $26.72, that means the actual market momentum has pushed the price above the average professional target.
It does, yes. This suggests that the recent bullish run-up in the stock price has actually outpaced the analyst's ability, or perhaps willingness, to update their formal models and price targets.
So the market is acting faster than the analysts can publish.
It seems that way.
Yeah.
The market appears to be pricing in newer information, or maybe just more optimism about the AI narrative, faster than the consensus view can officially react. Although it's worth noting the most bullish voice out there, Morgan Stanley, they recently raised their target significantly to $34.
$34. Okay.
That confirms that at least some high-end Wall Street analysis sees massive potential, likely tied directly to that AI narrative we keep coming back to.
Let's talk about the single event that seemed to really catalyze this recent market shift, this re-rating. The stock apparently soared to its best day in over 2 years, surging something like 16.15% on November 10th, 2025. What was the trigger for that huge jump?
Yeah, that was a massive move. And importantly, it wasn't triggered by a new car model announcement or a blowout sales beat or anything traditional like that. No. The surge was driven entirely by a market re-rating. That's the term used, based on the company's updates regarding its physical AI initiatives.
So the robots and the robotaxis again.
Exactly. Updates on the humanoid robot development and their progress on robotaxis. It seems the market consensus decided almost overnight that XPeng deserved to be valued differently. They started seeing it as potentially a high-multiple tech firm, like an AI company, rather than just a low-multiple car manufacturer subject to cycles and price wars.
It's fascinating, though, that this wave of market sentiment, this AI enthusiasm, completely washed over a piece of pretty significant negative news that came out right around that same time.
Absolutely. It shows you how powerful a narrative can be. The massive bullish enthusiasm surrounding the AI thesis was so strong that it completely overshadowed a potentially costly quality control issue. XPeng announced a recall of nearly 48,000 of their P7 Plus vehicles.
48,000 cars recalled. What was the issue?
A potential problem with the power steering system. Now, normally, a recall of that magnitude might hit a stock pretty hard, right? Raises questions about quality control, manufacturing costs.
You think so?
But in this case, the market largely shrugged it off. The interpretation seemed to be clear. The long-term, potentially transformative AI potential completely outweighs any short-term, expensive hardware execution flaw like a recall. Sentiment was just laser-focused on the future AI story.
Okay. And technical analysis seems to confirm this overwhelming bullishness currently. Short interest is very low, you said, 3.88%.
Yeah, that is a very low number for a stock like this that has faced skepticism in the past. And it tells us a couple of things. Primarily that the bears, the investors betting against the stock, have largely capitulated. They've given up or been forced out.
So the trade is crowded on the long side. Everyone's betting on it going up.
It suggests the trade is definitely crowded. Almost all the skeptical money that was betting against the stock seems to have retreated. Now, sometimes this can actually be a bit of a caution signal for traders. If there are no skeptics left, there's little fuel for a potential short squeeze to drive the price even higher. But undeniably, it confirms the dominant bullish trend right now.
And that dominant trend looks strong technically. Price trading well above moving averages.
Very strong. As of that no 12 date, the price was trading plus 21% above its 50-day moving average and a very strong plus 32% above its 200-day moving average.
So technically speaking,
this is a clear, powerful uptrend that has recently accelerated significantly. Momentum is firmly on their side, and the market structure, just looking at the charts, appears supportive of further upward movement as long as that bullish AI narrative holds sway.
Chapter 5, Ownership Structure.
Okay, let's shift now to who actually owns the company, because this, I think, reveals why XPeng is sometimes referred to as a kind of strategic fortress. The ownership is quite concentrated. The top 16 shareholders collectively control 50% of the entire company.
Half the company owned by just 16 entities. That concentration certainly suggests stability, doesn't it? And beyond the usual large institutional holders you expect to see, like Vanguard, Goldman Sachs, Morgan Stanley, we find these crucial strategic partners whose goals seem to align perfectly with XPeng's long-term technology vision.
Yes, that strategic block is absolutely key to understanding the stability here. You've got Volkswagen holding just under 5%, 4.93%. You've got Alibaba, the Chinese tech giant, holding close to 4%, 3.98%. And then you have Didi, the ride-hailing firm, holding approximately 3.25% as a result of that M&A deal.
And these aren't just passive financial investors looking for a quick return.
No, exactly. These are customers, like VW, using their tech, their technology partners, like potentially Alibaba in cloud or AI, or their ecosystem allies, like Didi being a major fleet buyer. They are all fundamentally aligned with the idea that XPeng needs to succeed technologically over the next decade for their own strategic interests as well. This creates an extremely stable, long-term oriented shareholder base.
And that stability must be crucial when the company is, as we've discussed, still burning cash and facing that brutal price war. You need shareholders with strong hands who will withstand the volatility.
Absolutely. And that conviction, that belief in the long term, it's mirrored directly by the management, and specifically the founder. I would argue the single most powerful non-financial data point in this entire deep dive comes directly from the actions of the CEO, He Xiaopeng.
Right. We know he already owns a massive chunk of the company, nearly 19%, 18.9%, which is worth what, almost $5 billion, $4.82 billion. So he already has immense skin in the game.
Huge alignment already.
But tell us about that specific personal buy signal from September 5th, 2025.
Right. On that specific date, September 5th, the CEO executed a significant personal purchase. He bought 3.1 million shares of XPeng stock, investing $31.9 million of his own personal wealth.
$32 million, his own money. At what price?
He bought them at a price of $10.30 per share. Now, you have to remember, corporate insiders, especially founders and CEOs, they don't usually buy large blocks of their own company stock for diversification purposes.
No, quite the opposite.
Exactly. They typically buy for one reason only. They possess perfect internal information. They know everything happening inside the company. And based on that knowledge, they believe the stock is fundamentally, perhaps grossly undervalued by the public market at that moment.
So it's the ultimate insider signal of confidence in the future.
It really is. And in this case, the market has, so far at least, validated his timing perfectly. With the stock now trading at $26.72 just 2 months later, he has already realized a paper gain of 159% on that specific $32 million investment.
Wow, 159% in 2 months.
His action back in September was effectively a powerful public declaration using his own money that he believed the future potential of XPeng was being significantly mispriced by the market at $10.30. This high level of alignment between the founder, the management team, and those key strategic partners we mentioned, VW, Alibaba, Didi, it creates a strong psychological anchor for the company, especially during periods of intense market volatility or negative news flow.
Chapter 6, Risk Assessment. Okay, we've heard a lot of the bull case, the optimism. Now we absolutely have to balance that with a rigorous assessment of the risks involved here. Let's conduct a thorough SWOT analysis, strengths, weaknesses, opportunities, threats, to really guide the listener through the codified pros and cons of this investment thesis.
That was good. Let's start with the strengths, recapping what we've established. First and foremost is their proven technology leadership. The XNGP autonomous driving system, the integrated CEA architecture, developing their own Turing AI chip. That's core. Second, the VW partnership. It's unprecedented strategic validation from a global giant, and it represents a direct, potentially high-margin future revenue stream through licensing. Third, brand strength. It's market-leading, at least based on that German NPS score, and supported by the AAA ESG rating, which helps immensely with perception and institutional access.
And the financials.
Fourth, the financial fortress. That massive $6.64 billion cash chest provides resilience. And fifth, that undeniable CEO insider buy signal adds a layer of confidence. Oh, and we can't forget the margin inflection. That 17.3% gross margin shows the operations are improving.
Okay, those are compelling strengths. Now let's be critical. What are the weaknesses?
The most critical glaring weakness is the ongoing lack of profitability. The net margin is still negative, -7.14%, and more importantly, they have consistently negative free cash flow. That means fundamentally they rely entirely on external funding or slowly depleting that cash pile just to sustain day-to-day operations and investments. They aren't self-funding yet.
That's a major vulnerability. What else?
We also have to flag the continuous execution risk. Yes, the company learned valuable lessons from the G9 launch failure, but the recent P7 Plus recall serves as a stark reminder that building complex hardware reliably at massive scale is incredibly difficult, and mistakes happen.
And competition.
And competition, absolutely.
Yeah.
They are fighting against absolute giants. Their relative scale, while growing fast, is still significantly smaller than BYD or Tesla in the crucial Chinese market. They're punching above their weight, but it's still a fight against heavyweights.
Okay, strengths and weaknesses laid out. Now let's look at the opportunities. These are the potential growth vectors that need to be massive and probably nonlinear to justify that high valuation the market is giving them.
Right. The first big opportunity is global expansion, specifically outside of North America, given the tariff situation there. Management is explicitly targeting 60 countries and aiming for 50% of their sales to come from overseas markets by 2025.
Ambitious target.
Very ambitious. But that proven success in Germany, topping the satisfaction study, gives them a potentially scalable blueprint for entering and succeeding in the lucrative European market. That's opportunity one. Opportunity two is the MONA MO3 mass market launch. This provides a massive new volume vector, allowing them to capture a whole different segment of the market, the high-volume compact segment, which they weren't really playing in before.
Okay, global expansion, mass market volume. And then there are the really high multiple AI revenue streams. This seems to be the heart of the bull case. It's pricing in future profits, right?
These are the potential game changers, the things that could really transform the company's economics. We're talking about technology licensing. The VW deal validated this model. They can potentially sell their platform, the CEA architecture, the XNGP software stack, to other legacy automakers who are falling behind and couldn't develop this advanced tech in-house fast enough. That could be very high margin.
Makes sense. What else?
Then there's robotaxis. They plan to launch dedicated robotaxi models next year, specifically targeting what they believe will be the world's largest robotaxi market right there in China. Huge potential, but also huge competition and regulatory hurdles.
And the really out there stuff.
And finally, the ultimate blue sky bets. Successfully commercializing their broader physical AI initiatives. That means the iron humanoid robot actually becoming a product and the land aircraft carrier flying car actually reaching mass production and finding a market. These are the far future bets that underpin those highly aggressive bull case price targets like Morgan Stanley's $34.
Okay, huge opportunities, but also huge execution challenges. Now let's confront the threats. These are the factors that could derail the whole story, perhaps existentially. You said the number one threat remains that fierce price war in China.
Without a doubt. The price war currently raging in the Chinese EV market is essentially a brutal battle of attrition, funded largely by balance sheets and cash piles. Companies are using deep, often unprofitable discounts just to maintain or gain market share, and it's absolutely destroying margins across the board. Consolidation, weaker players failing or getting acquired seems inevitable.
So XPeng's strategy is just to survive it.
Their strategy appears solely focused on being one of the survivors. They aim to do this by combining the high volume from the lower-cost M&A MO3, rapidly scaling their own gross margins through efficiency and product mix, and critically, deploying that $6.64 billion cash war chest to absorb the losses and simply outlast competitors who might run out of money first. They need some rivals to fickle so they can ultimately capture that abandoned market share.
Okay, price war is number one. What about macro factors? We're still in a relatively high global interest rate environment, aren't we?
We are. And high interest rates disproportionately punish exactly these kinds of long-duration growth stocks like XPEV.
Why is that?
Because their promised profits, the big earnings the market is betting on, are assumed to be far out in the future. A higher interest rate acts as a higher discount rate when you calculate the present value of those future earnings. So higher rates make those distant future profits worth significantly less today. Every interest rate hike globally increases the mathematical pressure on XPEV's valuation.
Got it. But perhaps the biggest, most absolute threat, the one they can't really fight, is geopolitical. That North American tariff brick wall you mentioned earlier.
This seems to be just a harsh fact of life for XPeng and other Chinese EV makers right now. Both the US and Canada have implemented tariffs reported to be exceeding 100% on Chinese-made EVs.
Over 100% tariff.
Yeah, effectively making direct export of their cars from China to North America impossible, according to the company's own vice president in public statements. This permanently closes off what is arguably the world's second largest and certainly one of the most profitable EV markets to them.
That sounds like a truly devastating blow to their long-term total addressable market potential. How can that possibly be framed positively? Yet our source analysis suggested interpreting this threat as potentially a blessing in disguise. That requires significant explanation, doesn't it?
It does seem counterintuitive, I agree, but the argument goes like this. It forces mandatory focus. Think about it when a relatively young, rapidly growing company perceives it has almost unlimited global market access. Management can easily be tempted to chase every single shiny opportunity simultaneously. Try to conquer Asia, Europe, North America, South America all at once.
Spreading resources too thin.
Exactly, leading to capital diffusion, organizational overload, and potentially mediocre execution everywhere. But by having the massive, complex U.S. market effectively permanently closed off to them by this tariff wall,
You're saying it forces discipline.
management is essentially forced to focus their limited, albeit large, capital and their finite management bandwidth on the markets where they have a proven right to win and a clear path forward, which are primarily China, their home market, where they already have scale, brand recognition, and the data advantage for XNGP, and secondarily Europe, where they have that validated #1 customer satisfaction score from Germany as a beachhead, and the AAA ESG rating to ease entry.
So the geopolitical risk becomes a kind of unintentional guardrail.
That's the reframing. It acts as a guardrail, forcing disciplined capital allocation. It prevents them from potentially wasting billions of dollars and years of effort trying to penetrate a politically hostile U.S. market where they currently have zero brand recognition and would face immense competition anyway. They are forced to double down on China and Europe and perhaps focus more on monetizing their technological lead via licensing globally, rather than fighting a likely losing political and market entry battle in the U.S. It forces strategic clarity, arguably.
Chapter 7. Conclusion.
Okay, so we have completed our deep dive. We've gone through the business, the management, the financials, market sentiment, ownership, risks. Let's try to synthesize all of this now into a clear bull versus bear case summary.
All right. The bull case seems robust and is really based on evidence of strategic execution, wouldn't you say? The core AI thesis looks validated at least partially by VW literally buying their tech. That margin inflection is confirmed in the numbers 17.3% gross margin and clearly climbing, showing operational improvement. Management seems to have executed brilliantly on key strategic moves, like the stock for M&A DD deal preserving cash and deliberately establishing that huge $6.64 billion cash fortress to survive the downturn. And crucially, you have the CEO putting $32 million of his own money on the line, signaling deep conviction.
That sums up the bull side well. The bear case, though, is simple but extremely potent. First, they still burn cash. Free cash flow is negative, period. The entire profit story relies heavily on flawless execution of future AI initiatives, which are far from guaranteed.
And the competition isn't going away.
Not at all. They must survive the daily bloody war of attrition against much larger, and in Tesla's case, globally established, players like BYD and Tesla in their home market. And as we just discussed, the massive, lucrative North American market is permanently closed off to them by geopolitical tariffs, limiting their ultimate global scale potential for vehicle sales.
Okay, bull versus bear. And this brings us back one final time to that core tension, the valuation paradox we started with.
Right. The conflict seems unresolvable if you rely solely on current fundamentals. Our conservative educational DCF model screams that the stock is 180.5% overvalued based on reasonable assumptions about the current business, and the current market price is already trading above the average analyst consensus target.
So pulling it all together, what does this all mean for you, the listener, trying to make sense of XPeng?
I think it means the current share price, $26.72 as of our analysis date, is undeniably a highly optimistic price tag. It seems to have already captured or priced in much of the good news, the impressive margin turnaround, the hypergrowth in deliveries, and the strategic validation from the VW partnership.
So the valuation is no longer about the present.
It appears the valuation now is almost entirely a pure bet on the future AI narrative truly coming to fruition. It's pricing in the successful development and monetization of those nonlinear, high-margin revenue streams, robotaxis, chip sales, software licensing that completely transcend traditional automotive profit margins. The market is betting heavily on that transformation succeeding.
The crucial ultimate question then, for you to mull over after listening to this, is whether XPeng's strategic fortress, that potent combination of deep liquidity and cash and validated technological leadership, is truly strong enough.
strong enough to achieve two incredibly difficult things simultaneously. First, outlast the inevitable painful consolidation that must happen in the overcrowded Chinese EV market. And second, while fighting that war at home, successfully monetize its technological lead globally, primarily Europe and maybe other parts of Asia, via licensing deals, and by successfully commercializing its ambitious new physical AI products like robots and maybe even flying cars.
It sounds like the easy money might have already made.
Well, the low-hanging fruit, you could say that impressive 159% return from the CEO's insider buy price of $10.30 up to $26.72, that gain has certainly been harvested by those who got in earlier, timed it well. What remains now at this elevated price level looks much more like a high-risk, potentially high-reward bet. A bet on near-flawless execution of a very ambitious AI tech vision, playing out in a relentlessly hostile, consolidating global market with significant geopolitical constraints.
That is indeed a profound and maybe sobering thought to end on. Thank you for joining us for this very detailed deep dive into XPeng Inc.
Yes, thank you for tuning in. We appreciate your attention through all 7 chapters.
Please, if you found this valuable, like and subscribe to Stock Analytics AI.
And remember, for $4.99 a month, you get access to our full library. 500-plus deep dive videos on S&P 500 stocks, the NASDAQ 100 coming soon, plus members-only requested deep dives. Check it out.
And finally, we have a required disclaimer. This analysis was generated by an AI system for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on anything you hear here.